So today we will be discussing on the dividends. So for dividends, again, if you see, we have qualified dividends and ordinary dividends. So qualified dividends are you may get 0% tax on that, or so it is 0, 15 or 20%. Tax calculation is a little bit different for the qualified dividends. We'll see how it works in tax calculation. Right now, today we will see what can be qualified dividend, what can be ordinary dividend, what kind of source document we get, and how to report each and every line item of the source document in this form. Okay. Again, for so for dividend also, you have to attach Schedule B, just like interest, if the ordinary dividend is more than $1,500. So if dividend or interest is more than $1,500, you have to fill this Schedule B, okay, with Part 1 or Part 2 and Part 3, okay. So if we see, this is 1099 DIV. So initially, these are the basic details: payer's name, address, and TIN number. As I told you, it is same EIN or PAN in India, we call it as. Recipient's TIN will be SSN for individuals. Recipient's name, address will be there. Amar, can you mute yourself? Yeah, thank you. So SSN will be there. Address will be there. Patka filing is same requirement which was there in interest income. Account number is also similar to that what is in interest. So these are same, right? Now coming to the box numbers. Now box number 1A, if you see, it is for total ordinary dividends, which includes qualified dividends. Okay. Now this box number 1A directly goes to box number 3B. Whatever amount is there in box number 1A will be straight away entered in 3B, which includes normal dividends, whatever the taxpayer is getting, plus it also includes any distribution as a dividend from mutual funds, and it also includes distributions from other brokers. So all the distributions in the form of dividends will be added here, including qualified dividends. Okay. Then we have 1B, qualified dividends. So these qualified dividends are reported on 3A, in this 3A, and there is a separate worksheet that needs to be prepared, which is worksheet for qualified dividend and capital gain. So that worksheet you have to prepare to calculate the tax. So qualified dividend, you will straight away add here whatever is there on line 1B, box 1B of 1099 DIV. Exactly the amount will be on 3A, and we will use these 3A and 3B to calculate the tax. So for this tax on these dividends. So there is a separate worksheet calculation for qualified dividend and capital gain taxes. So that we will be covering when we are doing the tax portion, how to calculate the tax. Okay. So, but for now, whatever income you are earning, you have to report it on 3A and 3B from box number 1A and 1B, right? After this, there can be a total capital gain distribution, which is reported in 1099 DIV. Now it is a capital gain distribution, right? So if it is a capital gain distribution, it has to be reported on line item 7, which is capital gain, for which you have to fill Schedule D. Okay. So here you will be reporting whatever total capital gain distribution is. Now this total capital gain distribution includes this, and this. 2B, 2C, 2D, and 2F. Total of this is added in 2A. So whatever total you are having, that whatever amount is here, that will be automatically added in total capital gain distribution and be reported in this line item 7. Okay. Now, if we see box number 2B, which says unrecaptured section 1250 gain. Now, what is unrecaptured section 1250 gain? For that, we need to understand section 1231 asset, section 1245 asset, and section 1250 asset. Okay. Now, in summarized form, section 1231 assets are those assets which are the business assets which have been sold during the course of the business. So what we do is, obviously you need to calculate the capital gain, right? So gain over here. So this topic is covered in sale of gain or loss on sale of business properties. Okay, so if you see on schedule 1 of 1040, we will be covering this on this other gains. So form 4797 is required for that. Okay. So we will be covering it when we will be using this form 4797. But as for now, just for a gist, what we have to do, section 1231 asset are required for gain or loss on sale of business property. So section 1231 asset includes both business properties which are real properties and business properties which are personal properties. Okay. Now here personal property does not mean personal. Personal property used for business. So what does that mean? Real properties are non-movable tangible property, whereas personal properties are movable tangible properties. So movable means you can shift that asset from one place to another, like vehicle, furniture, equipments. Non-movable means you cannot shift it from one place to another, like building, land. Okay. So section 1231 have both the properties included, wherein real properties are known as 1250 assets and personal property are known as section 1245 assets. Now here we are talking about 1250 assets, that is for the real properties. Now if you are selling the section 1250 real property, there is a concept of recaptured and unrecaptured. Why we need that? If there is any gain in section 1231 asset, that is known as capital gain. Okay. And if there is a loss, that is ordinary loss, not capital loss for section 1231. Section 1250 gain is ordinary gain. That means it will be taxed at your slab rate, not at the capital gain rate. Okay. Now, how to identify whether whatever asset you have sold, whether it is 1250 gain or 1231 gain. So whatever gain you are having, you have to bifurcate between these two. How you do that? Let's say you have sold a building for maybe, let's say historical cost of the building is $50,000. Accumulated depreciation, obviously there will be straight line balance method. So straight line method, let's say is $20,000, right? So your book value will be $30,000, and let's say you sold this for maybe $45,000. So your realized gain over here is $15,000, right? 45 minus 30. So 15,000 is your realized gain. Now, section 1250 gain, that means out of this 15,000, how much you can consider as the ordinary gain is lower of realized gain and accumulated depreciation. So in this case, since the whole 15,000 is below accumulated depreciation, so you will be considering whole $15,000 as section 1250 gain, which is recaptured 1250. That means unrecaptured is 0, right? But let's say instead of 20,000, accumulated depreciation was $10,000. Okay. If it was 10,000, so your book value was maybe, okay, let's say it is 20,000 and selling price is higher. Let's say selling price is 65,000. So if it is 65,000, then realized gain will be 35. Realized gain will be $35,000. 65 minus 30. Now, if this is a case, in that case, what will happen? Lower of the two will be section 1250. Lower of accumulated depreciation and the realized gain. So 20,000 will be considered as ordinary gain, and which is a recaptured 1250 gain, and remaining 15,000 out of this 35, 20,000 is section 1250 gain, right? Remaining $15,000 will be considered as unrecaptured 1250 gain, or we call it as section 1231 gain, or we call it as capital gain. Okay. So that's why this amount is added in total capital distribution and reported in here capital gain.